Welcome to Momentum Monday. Today is November 21st, 2021. Howard, how's life?
Life is good. I just went for a ride. I'm in Phoenix. It's beautiful out.
Amazing.
It was a tough grind. I was on the road for a week, family events and work and bad weather and borders and COVID. And good to be back home. Good, Phoenix is my home. It's becoming more and more. I really didn't perceive myself enjoying it as much as I enjoy it. How's San Diego? I miss San Diego.
San Diego is incredible. The weather is like, I don't know, 66, 67, sunny. It's really nice.
You guys had a good October, November, because Phoenix had a great October, November.
Yes. I mean, it was a little bit warmer than usual, but other than that, incredible.
I got a lot to flesh out today, but you start.
Okay. So currently the market has two faces, I would say. To me, it seems like the market is still worried about COVID. Mm-hmm. If you look at the price action in the past couple of weeks, anything that is related to the reopening, to going back to normal, has been under heavy pressure the past couple of weeks or so, like airlines and entertainment and dining out, like anything in that field has been straight down for the past couple of weeks. While the big tech, which is, I mean, the biggest winner really from COVID and working from home, it's just continues to make new high. Apple, Amazon, Shopify, all of those, Nvidia, Google, all of those mega cap stocks, they just continue to make new high, continue to attract capital and interest. So this is basically what's going on currently in the market. While the small caps definitely pulling back. I mean, small caps are kind of a benchmark for the reopening play, definitely showing weakness. And if they don't hold, I would say 230, we can consider this breakout from early November a failed breakout.
Yeah.
So what do you see?
Well, that's the most watched thing from the technical people that I follow. I mean, I've been on the road. I've really had to, I've struggled. If I look at my stock portfolio this year, my 8 to 80 flagship where I keep most of my capital, it's completely tale of two markets, right? So you've got, I miss Tesla. So Tesla's not on my portfolio. So that's just a miss, right? When you in an 8 to 80 portfolio, not having Tesla, it's just been a miss this year. And not only Microsoft has been a miss, and I don't use Microsoft products, and I feel like they've been a great roll up, and just a mistake. So I went with the fangs of Netflix, Facebook, Apple, and Amazon. So I've gotten the fang mostly right? Like if you were in the FANG stocks, Apple's at an all-time high, right? Like this is an index market. I think people are really freaking out here at the end of the year because if you were in the FANG, like you killed it. And so therefore, if you were in the indexes, you just killed it, right? You just had to be long FANG. You're up 26%. The Qs are up higher. And so I got that part right? You got to own some FANG. But in my stock picking, my 8 to 80, I've really gotten it wrong, right? I got Bitcoin and Ethereum. I put into my 8 to 80 in the summer swoon for people, and we got that right. But Peloton, Zoom, switching out of Lulu, trying to think what else I got wrong, and Zillow. So I got caught up in this bear market in non-growth companies. So I stuck with founder-led businesses. Like if you look at Peloton and Zoom and Zillow, they're founder-led businesses. What I think I got wrong, well, obviously I got it wrong. I've been stopped out of one of them, but I got Lulu wrong because it's just bigger than I thought, right? Their core audience could care less about the mirror, but everybody's spending money at Lulu. That's just the default place where young people go to spend money on casual. But I thought strategically they made a huge mistake not getting into the hardware, and compounded it by buying Mirror. So I got, not only did I switch out of Lulu for Peloton, I rode Peloton too long. So again, I go with founder-backed companies, and they've just completely blown the pooch, and I stopped out of that in the 60s. So when you're in the stock picking mode and you get 3 or 4 wrong, it's going to be very tough to beat the averages. So it's a good lesson for all the way around. I've added Airbnb to my 8 to 80 portfolio because I feel they're just strong combination of being the network, having this leverage in their network, and being, surviving COVID for the most part, and having this incredible compounding effect of the marketplace. I think they're going to be around for 50, 100 years and can continue to compound returns. What I got wrong with Zillow, if we pull it back up, is they got away from their core business. And so it was becoming a holding company, it was becoming a financially leveraged company, and that leverage came home to roost. And the founder can't seem to fix the organic growth, and the financial trickery of buying and selling homes is just a disaster, obviously. And kudos to the people that got that right. But that's just, after a great run to 200, which I caught, it's, on the verge of just giving up there. So great founder, great brand, not enough organic growth. But this has been a horrific, I'll go through the great brands that have been down over 50% off their 52-week high. Pinterest, DraftKings, Palantir, Lyft, Chewy, Snapchat, Twitter, PayPal, Baidu, Alibaba, Zoom, Robinhood, Teladoc, CRISPR, Penn Gaming, Beyond Meat, Virgin Galactic, Lemonade, Peloton, Zillow, Stitch Fix, Clover Health, Tencent Music, Chegg, Stone, Smile Direct, SPACs imploding left and right. So unless you were in the right sectors, and I think the right sectors are QQQ and SMH. So the other thing I got wrong with semiconductors, Ivan, if we pull up the semiconductors, you've probably been long them all year. I have this is where, not being a young internet gamer / understanding, thinking chips were cyclical versus chips being a part of every single process as the internet grows. The chip industry changed with Web 2.0, and I just had that old mindset of chips, that analyst mindset there, from all the brokerage reports over the years of chips being cyclical businesses. Some chips will be cyclical businesses, but there's enough chip companies that are just purely growing with the internet, high margin chip companies that, like AMD, like NVIDIA, I like Apple itself with its own chip, right? Completely vertically integrated Apple, and probably eventually Tesla will start doing its own chips. You know what I mean? Because at the end, they'll become reliant on somebody else's infrastructure to power their software. So again, semiconductors got that wrong. I think it's been a tough stock pickers market. If you weren't in software, semiconductors, and crypto, this has just been a year to kind of reflect on how you're thinking through your portfolio construction. Another really interesting podcast, I'll link to it tonight in my post, is I was listening to, I'm lucky to be an investor, but Multicoin Capital, I was listening to a podcast they just did with Ted Sides, who's a great allocator or an investor that invested in their fund, like myself. And even though they're young and this is kind of their first big hit, and they've only been running a fund for 4 years, the fund's gone to $4.5 billion of the wins of Helium, Solana. If we pull up the crypto, just truly riding Helium, Solana. And they said a couple of things in this podcast that I'll share. And this goes to me getting semiconductors wrong for the last 10 years, and me not having even more of my 8 to 80 towards, network dominant businesses. This mean reversion that we're used to seeing in the stock market. You know, it's kind of a thing that everybody talks about. You know, if a stock goes up quickly, because the fundamentals are based on earnings, and not any other measure. For the most part, we're used to seeing mean reversion. So people sell into big gains, right? And that's just profit taking has been a normal thing and trading around positions. But if we look at the layer one tokens like Bitcoin, Ethereum, Solana, there's been none of that. If you had done mean reversion, you're crazy. And so there's this whole new software investing cycle around, investing in these platforms and these networks and this idea of compounding that happens on platforms, especially decentralized ones where there's no centralized management. That's making me rethink how I think about long-term portfolio holding and construction. So this has been a year that's really kind of forced me to really think through, even though in a year where we've had just tremendous success, like even though I've been wrong, I'm still up a lot. But when you underperform the indexes like I have, you have to start thinking about, how you're picking stocks. And so I reflect on that, but there's just been a lot of carnage, Ivan.
Yeah, definitely. I mean,
yeah.
If you don't take into account like the semiconductors and the top 8 stocks by market cap, there's definitely be a lot of significant pullbacks all over the place, even in tech, like payment companies like Square and Etsy, which were big leaders for the past 2 or 3 years. Plenty of weakness. If you're a short seller, there's definitely plenty of material, even in a market where the S&P and the QQQ are at all-time highs.
Yeah. So I'm excited about what the opportunity is, right? Like there's so much money moved to crypto. Now we have this second market that trades 24/7, 365. And I don't think what's exciting to us, or at least hopefully to you and me, is that this, the government of the United States is focused on like Robinhood and the retail investor and payment for order flow. The retail community of the global economy, now that all these apps exist, is America's, trading is what drives crypto, and we're starting to get into the consumer part. Maybe there's enough applications built and there's enough people working on stuff. But if we think that we can put this in a box, as China's seen with mining, America is going to be, completely left behind here. But this retail generation that's flowing through onto the market is incredible.
Yeah. Did you get lost? Howard.
Hey.
I can hear you now. You got stuck for a while.
Go ahead. I just got a family crisis. I got to help out with the car. Take it away for a minute.
Okay. So as I said, the Russell 2000 definitely the main reopening play, at least the benchmark, under pressure lately. It's been in a pullback for the past couple of weeks. I think 230, 232 is a major area of potential support. And if it doesn't bounce there, we can see much bigger pressure on those types of stocks. Look at financials.
Sorry, Evan.
Yeah, it's fine. Financial testing the 50-day, all of those so-called reopening sectors has definitely been weak lately. And to top it off, the vaccine stocks are starting to wake up after a 50% or more correction. Last week they were the best performers, BioNTech and Moderna. Pretty significant accumulation day after day. So with all those new lockdowns in Europe and new measures around the world and increasing cases in the US, it seems the market's worried about COVID. It might be a short-term worry. It might be just a 2-3 week phenomenon that we might see another rotation in a couple of weeks. But as of right now, that's definitely on the top of the market's mind, and is definitely deciding capital allocation. This is why we saw those big breakouts in Shopify and Amazon in the past couple of weeks. Stocks that missed their earnings significantly, citing supply chain pressures, the market didn't care. They were bought in, they were accumulated on a significant volume, both of them. So this is the major theme right now. Still COVID and versus reopening plays.
Well, I think the other big theme, Ivan, is that decentralization is here to stay, and there probably won't be a Facebook, Amazon, or Google of it. Well, there won't be. It's just the way decentralization works. So it's a great retail. All this retail money is going to slowly move to decentralization because it's fun and it's 24/7 and it feels less rigged, even though it's very dangerous. In the centralized world, if money is flowing to decentralized by en masse from small investors, right, the institutions are going to index more than ever. And I think you're starting to see that in that the FANGs are outperforming. So in a move to decentralization, the centralized leaders are getting stronger because of the capital and the fact that decentralization is splintering so many of these medium-term winners. Eventually, decentralization will have its effect on the FANG stocks, but right now it's like helium's going after AT&T, Verizon, in a way, right? It'll take maybe a decade, but like Verizon is what's going to get disrupted by decentralization with something like helium, like AT&T and Verizon. But Facebook is a long way from getting. So I think the money flows that are staying in the market feel more comfortable owning the centralized winners. But the real winners, if you were picking this year's stocks and momentum and relative strength, has been in the decentralized world and in the small cap world. And I think we got to see here, the small caps need to hold this. This is why the technical analysts are chirping so much right now.
Yeah,
that was a big breakout, and people are nervous. Odds are that there's a lot of support here, and unless COVID rears some weird, ugly head here, cooler heads should prevail. But when I see Solana, Ethereum, Bitcoin strength, I see Google strength, I see Shopify strength, I see Amazon strength, and I see Microsoft strength and Apple at all-time highs, very hard for me to get negative.
Yeah, I mean, they're just rotation. Money is not going to leave the market. There's plenty of money in the system. It will just rotate. You just need to pay attention to the sector and team rotation.
Yeah, and I wasn't paying attention, just this has been a brutal kind of bear market for if you're in the wrong stocks. So what a bunch of family interruptions today. I apologize, everybody. But I'm gonna run. The Suns are on a 10-0 run. I'm gonna go watch them play tonight in Phoenix. And have a great week, everybody. I'll put some links in the blog post tomorrow.
All right, Carl. See you.